Housing affordability, inventory, mortgage rates. What's the Fed's next move, and what's truly happening in the Orange County market? We're also going to review the distressed property inventory. All questions buyers and sellers are asking. Stay tuned for the MMG market breakdown, where we keep you in the know. It's Christopher and Brooks Marr with MMG Real Estate Advisors, your trusted local Orange County realtors, bringing you the pertinent information you need to know to make informed, confident real estate decisions. Now, let's get to it. The Housing Affordability Index for Californians has hit its lowest rate in 16 years, with only 15% of California households able to afford to purchase a median-priced home, which currently is $843,600 as of the third quarter of 2023. This is down from 16% in the second quarter of 2023 and down 18% in the third quarter of 2022. The California Association of Realtors reported a minimum annual income of $221,200 was needed to make monthly payments of $5,530, including principal, interest, taxes, on a 30-year fixed-rate mortgage at 7.14% interest rate. 23% of home buyers were able to purchase a medium-priced condo or townhome at $650,000, for which a minimum annual income of $170,400 was required to make monthly payments of $4,260. Housing affordability has been exacerbated with a sharp rise in mortgage rates since 2022, as you can see by this graph. Housing inventory has been an issue since 2020 and isn't expected to grow significantly until affordability improves and mortgage rates drop into the mid 6% range. Sellers simply aren't willing to trade their historically low rates and payments until the affordability gap narrows, unless you're paying cash. Now, nationally, homes purchased entirely with cash accounted for 34.1% of sales in September. That's up from 29.5% a year earlier, and the highest share in nearly a decade, according to an analysis of home sales in 40 of the nation's most populous metropolitan areas. So, what's the outlook for mortgage rates? It's important to understand the Fed, or more specifically, the Federal Open Market Committee, is the one that dictates the movement of mortgage rates based on their policy and whether they pause, raise, or cut the Fed funds rate. They meet 8 times a year to determine policy after reviewing several economic reports, such as inflation, GDP, unemployment, just to name a few. At the Fed's November meeting, they unanimously decided to maintain their pause and not raise rates as they felt the October economic numbers didn't warrant it. The inflation report showed it pulled back from the blips we saw in August and September. Remember, the Fed's target rate is 2%. With the Fed's pause, we saw interest rates come off their highs, but the 30-year fixed-rate mortgage still remains in the 7% range. Unless something significantly changes, the Fed will probably leave rates unchanged at their December meeting. Their first meeting in 2024 will be January 31st. If you find this information insightful, give us a thumbs up and subscribe so you don't miss any future videos. Now, for the breakdown on the Orange County market, here's Brooks.
Let's start by discussing inventory. As the holiday season approaches, the number of homes available for sale decreases because fewer homeowners decide to list their properties towards the year's end. December sees the fewest new sellers, 64% less than the peak month of May, resulting in fewer for sale signs. This decline, along with some sellers withdrawing their listings, leads to a significant drop in available homes. With reduced demand, many buyers take a break from their home search. Those who persist encounter a dwindling pool of homes for sale, causing a decline in pending sales. The scarcity of available properties, especially in entry-level categories, has persisted throughout the year, making it challenging for buyers to find what they seek. Over the past 2 weeks, the active listing inventory saw a rise of 90 homes, marking a 4% increase, reaching a total of 2,496 homes, the highest level recorded since January. Typically, after reaching its peak, the inventory gradually declines, picking up speed, as the year comes to a close. However, with the onset of the holiday market today marks the peak, as November and December witnessed the fewest new homes hitting the market. Many sellers, unable to make headway, opt to withdraw their listings. This trend will likely lead to a sharp drop in inventory from now until New Year's Day. Last year, the inventory stood at 3,581 homes, marking a 43% increase of 1,081 more homes. To put this more into perspective, the 3-year inventory average from 2017 to 2019, or pre-COVID, was 5,822, making today less than half of that. Homeowners are inclined to stay put due to their existing low fixed-rate mortgages, contributing to the current inventory stagnation. The recent snapshot of demand, measured by new pending sales over the previous month, shows a decline from 1,284 to 1,223 in the last couple of weeks, a drop of 61 pending sales, or 5%. These levels of demand are notably low, primarily due to the seasonal trend of fewer homes entering the market. Additionally, persistently high mortgage rates hovering above 7% and even reaching over 8% last month contribute to this decline. As sellers withdraw their listings and fewer homeowners choose to sell in November and December, demand is expected to continue its gradual descent, reaching its lowest point on New Year's Day. With supply on the rise and demand on the decline, the expected market time, which measures the number of days it would take to sell all Orange County listings at the current buying pace, increased from 56 to 61 days in the past couple of weeks, its highest recorded level since January. In comparison, last year's expected market time was 89 days, indicating a slower pace than what we are experiencing currently. Now, the luxury market. The luxury market slowed considerably in the past couple of weeks. Over this period, the inventory of luxury homes valued at over $2 million saw a slight uptick from 807 to 819 homes, marking an increase of 12 units or 1%. However, luxury demand experienced a significant decline of 30 pending sales, dropping by 16% to a current total of 162, reaching its lowest point since February. This shift, characterized by a rise in inventory and a dip in demand, led to an increase in expected market time for these high-end properties to 152 days from 126 days, an ascent to its highest recorded level since January again. Compared to April's figure of 101 days, roughly over 3 months, this current 152-day expected market time indicates a considerable slowdown in the luxury market. Given these changes, sellers in the luxury segment should approach the housing market with careful consideration.
One of the top 5 inquiries we receive is about distressed properties in Orange County. Who isn't looking for an opportunity to enter the market or move up at a discount? Here's a chart showing the activity of distressed properties in Orange County by city. Both short sales and foreclosures combined comprise only 0.2% of all listings and 0.1% of demand. Only 4 foreclosures and 2 short sales are available today in Orange County, with 6 total distressed homes on the active market, up 2 from 2 weeks ago. Last year, 7 distressed homes were on the market, similar to today. Low demand, strong equity positions that many homeowners enjoy, along with historically low mortgage rates from 2020 and 2021. Well, this is not a recipe for a market full of distressed properties, which is evident by these numbers. If you have any questions about anything said in this video or something you've read online, feel free to drop us a comment or give us a call, text, or shoot us an email. We're here to help you navigate the home buying and home selling process and be a trusted resource you can rely on. If you feel there is someone you know that can benefit from this information, well, then give it a share. And until next time, thanks for watching, and we'll see you on the next video.